If you're within 5 years of retirement, don't make this mistake.
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks, everybody, for listening and watching.
Great to be here as well. So when Trish and I, when we plan out our episodes, we try and come up with an idea we think we need to have a conversation about. And I like this one where we talked about 5 years before retirement. And we started making a plan up for episode and realized that he and I went down completely different paths. And so we might actually have 2 episodes out of this. So today we're talking about a lot of the financial concerns when you're within 5 years of retirement. This is the period where you have been saving a lot during your working career, and you're now starting to think, hey, I might have enough to actually stop working and stop saving and start using my investments, my portfolio to support my lifestyle. So we're going to go into a few of the both high-level things to think about from a financial perspective, cash flow, investments, and starting to prepare for retirement. So you're still working, still saving, likely into a 401k, probably outside of 401k as well. But you can see, okay, this is no longer just I'll get there eventually. It's trying to plan out, okay, this is going to happen in 3 years or 4 years or 5 years. How long do I continue working? But I need to start preparing for that a few years in advance. And this is going to be a lot of the traditional financial advice that advisors will give to clients when they're starting to get close to retirement, but not quite there. Okay. So Trishul, we're going to set our retirement age at age 60 for this conversation. Because it makes a lot of the tax law stuff around 401ks and IRAs just a little bit easier. So if someone comes to you and they are 55, we'll say husband and wife, they've both been working, kids are out of the house, not really a concern, but not a big part of the conversation. They've been saving into 401ks and outside of 401ks. What are some of the first thoughts that go through your head of, okay, what do we need to kind of check and how am I going to help them get from age 55 to age 60?
Yeah, I think it's worthwhile at the beginning of this initiative to just lay out what are we trying to do, right? Have that helpful conversation with a client.
Mm-hmm.
The notion is it's not 60, for example, isn't some magic number. It could have been 65, it could have been whatever. But then we want to understand, okay, well, what does this mean? Like, what's exactly happening here? And why are we calling it this event, right? So the high level notion, you had alluded to this, is it's essentially a cash flow change, right?
Mm-hmm.
What's happening is around this period, income from employment is likely going to taper off or stop. And what that means is the cash flow that's supporting the household will need to be supplemented, likely with the nest egg. And the idea there is, well, how do we make that transition? And then how do we make it so that nest egg never runs out of money over the entire predicted lives? Well, and then some, right? We don't want to, do our analysis based on the average individual's lifespan, right? Because then half of our clients would be quite disappointed.
So we're gonna have to have a little safe withdrawal rate conversation here. Okay, go on.
Right. Yeah. So then the initial high level discussion is, well, first let's talk about what's going to likely happen. Likely, as we said, employment is going to dovetail. And what that means is over your career up until now, the goal is to build that nest egg, right? To accumulate assets, to increase your net worth. And the transition is going to be to a situation where you're decumulating assets, meaning you're leaning on the assets to support your lifestyle. And again, it's not a it doesn't have to be a fine transition point at age 60, but if it is, there's going to be a transition period, and we want to be aware of that. So that has all these other implications, which I'm sure we'll dive into.
So one of the first specific things that I introduce to clients, especially if we've been working together for a while, we'll probably have had this conversation well before 55. But that 5 years before they retire is a very common time where people start to seek out an advisor. They sort of realize, oh, this is different than what I've been doing for the last several decades. I think I need some help now. And the reason I say that is it's very common if there's a couple of their 40s, they are working, saving a lot in their 401k, saving a lot outside their 401k. They're probably keeping the rest pretty simple. I have talked to people like they save in the 401k, all stock, and VOO outside there. If they're working with an advisor, I'd probably say, hey, we'll probably want to have some small cap. VOO is the Vanguard S&P 500 ETF. So it's just a US large cap index fund. I'd probably say, hey, we want to have some international stocks as well and some small cap stocks in there, but an all stock portfolio in your 401k at age 40, knowing that we have 20 years before you're going to touch it, makes a lot of sense. So age 50 or so is where I'd start talking to clients about planning. This is the first time where we might not want an all stock portfolio. That idea of like about 10 years where the conversation starts. At age 55, so 5 years before retirement, we definitely need to be making some changes. And the idea here is while they're accumulating, if they have an all stock portfolio and it goes down 40%, because we have seen that happen, you have plenty of years for it to recover. And the buy and hold plays out really, really well if you have a long-term time frame, if you have a decade to wait for it to recover. Almost any strategy that have been accumulation going through 2001, 2008, if you had an all-stock portfolio, went down, and you just waited 5 to 8 to 10 years, you would be much better off. So this is the time where if you're 55 and your all-stock portfolio drops 40%, you don't have time to wait 8 years for it to recover. And this is the time where we start figuring out, okay, we need to take some risk off the table. We need to start transitioning your investment portfolio from an all stock portfolio to likely some mixture of stocks and bonds. Now, the time frame matters, the risk tolerance matters, how much looking to accumulate in the next 5 years kind of matter. But this is the first way, like I'm confident if a 55-year-old comes to me like, hey, we like to retire at 60. If I see that their 401k is all stocks, like, okay, we need to make this change. That we need to start selling some of the stocks, buy the bonds, probably at least 80% stocks, 20% bonds, maybe closer to 60% stocks, 40% bonds. But we need to figure out that glide path of, okay, in 5 years, we should probably be closer to that 60-40 or 50-50. How do we get there from here to there? That tends to be one of the first things I look at of this is a change I'm confident we're going to make that is different from the accumulation phase. We're not withdrawing from the portfolio yet, but this is one of those changes that is very top of mind for me.
Yeah, that's certainly an important one. Most people, when they're younger, are taking a lot more risk. And, as you get older and you're transitioning to this decumulation phase, you just don't need to take on so much risk. What I kind of like to say is if you're employed and you're earning income and you're saving and you're building your nest egg, sure, take on risk, right? Make choices in your life that are more risky than you would otherwise. Why not, right? That's the time to do it. But what I'd like to say is once you're in that transition period and once you are in call it a retired state or basically a financial independent state, it's a different concern, right? The
Yeah,
notion
yeah,
there is you won the race now. You
yeah.
don't need to go out and beat more things or get more
Mhm.
checkpoints. The goal here is sustainability, right? You want to come up with a solution that doesn't derail the whole ship. And the idea there is typically if you did end up having a lot of concentrated positions to get where you are, maybe it's from your employer, you're in tech or something like that, or you just had some stock or whatever that you've had for like 20 years and it is a very large size of your portfolio. Now is a good time to really
Mhm.
start putting effort into diversifying that away from those concentrated positions. Because again, the notion is you don't need to take on that risk anymore.
Yeah,
You're already at this point where the finish line or the financial independence line is within viewpoint. And the things that can mess it up are either being too risky, Aaron, as you
mhm,
alluded to, just being too heavy in stocks when you don't need to take on that much risk when you're in a financial independent state, or not being diversified enough, right? Having
yeah.
too much of concentration within your own portfolio.
That's a great point. When I think of going from stocks to bonds, you're right. I'm trying to reduce the risk of the portfolio, but going from a single company stock to a diversified portfolio also helps reduce the risk. So those could be two parallel strategies that we're starting to look at of just, and it falls on the theme of in general, let's reduce the risk of your investments because we don't need the super high reward. We're not trying to maximize return any longer. We're trying to hold on to what we have.
Yeah. And, in parlance is basically switching from like a growth mindset to like a preservation mindset.
Hmm.
And there's different levels of that, but that's just the high level theme. Like the notion here is how do we preserve your nest egg so it can support you in essentially as long as it needs to.
Yeah. The next thing I start to look at with clients, okay, again, I'll say new clients, we're about 5 years away, is actually starting to do some pretty specific financial projections. We probably have a pretty good idea of what your income might look like over the next few years. We if we don't, we're going to start working on getting a good idea of what your expenses are, just kind of what is your lifestyles. Uh, Again, at 5 years in advance, we may don't need to be super specific, but by the time we get to retirement, it really helps to have a good idea of I have $2 million. I'd like to withdraw $100,000. Is that okay? Versus I have $2 million. I'd like to withdraw somewhere between 90 and 120. Like, oh, okay. One of those is better than the other in terms of the math projection. So over the next 5 years, just starting to get a little clarity. There are a few strategies I like. One, some people like tracking their expenses. They'll have a spreadsheet. They can download spending reports from their checking account and their credit card, and they get a good idea what their expenses are. Another one is just taking a look at their take-home pay from either their salaries, or it could be salaries plus RSUs, but their end-of-year pay stubs do a pretty good job of here's what your take-home pay was for the year. As long as they weren't adding to credit card balances or we're seeing big decreasing cash balances, that's probably a really good proxy. Like most people tend to spend their income unless they're saving it specifically. And again, we can track that as well, but we can kind of back into what we think are your expenses.
Mhm.
Uh, and the key is like, again, we're not to make any changes, but let's just start adding some kind of tracking over the next few years.
Mhm.
Because we can start to say, okay, we are likely going to earn this much over the next 5 years for each year. We're likely going to save this much in your 401k or outside of 401k and taxable investment accounts over the next 5 years. So from savings alone, we might add a certain amount. So if we have husband and wife both working, both maxing out the 401k this year, the max contribution to a pre-tax 401k is 24,500 in 2026. I'm going to make my math easy. Say it's 25,000 times 2 for husband and wife is 50,000. So we might be able to add $250,000 to their portfolio just from savings over the next 5 years. Okay. We might want to add in a little growth assumption. I tend to be conservative. Say we'll get 7%. We may bring that down since we're going to get, again, more conservative on investments, but 5, 6, 7% rate of return. I do like a 3% inflation, but so we're only getting 2 to 4% real return. We'll start to have some wiggle room there. Again, we're not going to get 7% each year, but we can probably assume we'll get a little bit of growth and start to look out. Okay, from what you have now, plus 5 years of savings, plus a modest growth, is that enough to support the lifestyle that you'd like to maintain? And again, if we have a good idea of the expenses based on their take-home pay, then we can start to apply either Monte Carlo simulations or safe withdrawal rate research and say, okay, in 5 years, we think you'll have this much in your total nest egg. We think your expenses are this. What is your withdrawal rate? If you have $2 million, are you withdrawing $100,000? That'd be a 5% withdrawal rate, or withdrawing $80,000, which would be a 4% withdrawal rate. And it's like, do some math and figure out, okay, what are we on track for? So before I get to like my interpretation and results of withdrawal rate research, how does that fit in with kind of what you think of in terms of the financial projection part of the next 5 years from 55 to 60?
It's pretty close. So for me, it's kind of like peeling an onion. I like to start with a very simple scenario and then go to like a slightly more nuanced scenario. And then eventually the goal is to get to like the full simulation and model with all the bells and whistles. But I like to start at the highest level. Like in general, the intro conversation on this topic will likely include something that's very, very simple and high level. Like, for example, I'd say, how much do you think you need to retire? Right. And just say, well, where'd that number come from? Right. And let's say they settle in on something like, oh, I need $2 million. I'm like, okay, let's talk about that. 2 million. Well, just pull out a napkin and say, well, what that kind of implies is at age 60, if you have about 2 million, we could probably pull out 4%. Have you heard of the 4% rule? Then we talk about that, right? So what the 4% rule quickly says, and it's just kind of like a rule of thumb. It's not like a law of nature, but what it kind of says, and I'll talk about why it says it, is that typically if you're retiring at age 65, you should be able to pull out 4% of the nest egg and adjust that for inflation on a go forward basis until for the rest of your lives. And high level safe withdrawal research has suggested that that's a safe amount to withdraw.
I'll add in here that the research shows that over any historical 30-year period, going back century plus, so we actually have the data, there's been no period where if you started at 4%, if you withdrew that amount, adjusted for inflation over a 30-year time frame, at no period did you run out of money. You got to like zero in the worst case scenario. That's why it's considered a safe withdrawal rate.
Yeah.
There are plenty of 30-year periods where you could withdraw more. The average withdrawal rate is actually closer to 6%, and the highest was actually closer to 8%. If you retired like the late 70s, you got bull markets of the 80s and 90s. But the idea is that we don't know what the next 30 years are going to look like. So we start from that safe number of no historical example of you ever running out of money if you withdraw 4%.
Yeah. I think there's some caveats. For example, I was assuming you're starting at age 65, not 60, for 30 years, living till age 95.
Yep.
Also assumed a 60-40 portfolio. So again, if individual responses are different, adjust accordingly. And then I think it's probably important to mention that with the 60-40, with the 4% rule, I think there were a few edge cases where they did have to, they did realize things got
9.
Yes, something like that. Yeah. But again, just some footnotes on that. But what this does is it just gives the client a high level notion of where do they stand. For example, if we have the conversation, they say 2 million, I'm like, okay, that means we could roughly pull out 80K inflation adjusted. What are your expenses now? And they might say, oh, look, 80K does feel comfortable. Or it might say, oh, no way we could do that. We need twice the amount. Well, that's a whole different conversation, right? But at least it gets us in the right ballpark of thinking. And it helps the client understand this is what we're driving after. Like, is there enough money to support this lifestyle indefinitely, right?
Yeah. So here's where I'm going to add a couple caveats that it's almost like safe withdrawal rate. Like if you understand the research, this would support what I'm saying, but their conclusions don't line up with what I'm saying right now. Mm-hmm. And this is why financial planning is a very individual process. It is different for each household. Mm-hmm. One, safe withdrawal research does not account for Social Security income. If you retire at 60, and whether you take your Social Security at 62, 67, or 70, whenever you start it, the fact that there is some future income implies that you could withdraw more at age 60. And so, like, maintain your lifestyle. And then when you get to 70, that's why I usually recommend my clients start Social Security, the withdrawals drop, but Social Security income makes up and their lifestyle maintains the same. So if we account for future Social Security income, that does imply that we could have a higher withdrawal rate at age 60, knowing we're going to have a lower withdrawal rate at age 70. Again, that's very individual. Not everyone who gets Social Security. There are certain levels of Social Security depending on their income. There are programs like California teachers and those contributing to CalSTRS don't get Social Security because they haven't been paying into Social Security unless they've also been working outside the teacher system. So there's a lot of individual caveats there that the safe withdrawal rate research can't support. A couple things that, like Trishul said, it's designed for a 30-year time frame. So it's going age 65 to age 95. This gets into longevity and mortality, where like if you go to an insurance company that does annuities, they can plan out, oh, half of our customers are going to pass away by 86. Like if they start at 65, a lot of them only make it to 85, 86. We only need to pay for half, making it 20 years. And those half kind of fund the half that live longer. On the individual basis, we can't plan on you living to 85 because there's a 50% chance you live longer. So we have to plan for some of the longer case scenarios just in case you live that long, even though most likely you won't live that long, but we don't know which of our clients will live that long. And so each individual has to plan for that longest time frame. But if we start thinking, okay, if we're at 60 instead of 65 and we have a 35-year time frame, or if we're at age 55 instead of 65 and we have a 40-year time frame, that does reduce our withdrawal rate. And that there is some research that supports that as well. So that's why I say the 4% rule of thumb safe withdrawal rate has a lot of caveats for each individual household. And that's where good planning comes into play. So it's, again, a great, like Trishul said, first layer of the onion. Great conversation to start with. But as we get deeper, working with a planner who understands safe withdrawal rate research, you understand kind of how do we apply this to you as the individual. So is there anything you want to add to the safe withdrawal rate research side of things that you see or look at that might differentiate from what a large data set research kind of has to restrict themselves to?
No, that's kind of it. It's just a first order approximation. It gets the conversation going. Like if you're not used to these types of numbers and how they flow through, just having a baseline to get your thinking in the right hemisphere, right? To just get some sort of intuition on what these numbers mean.
Yeah.
It puts it into perspective. And then the goal is to get it so that we can withdraw as much as we want, right? Or much higher than 4%, ideally, and still be comfortable with it because we've done the analysis. And that can make a big difference. For example, if we go through the different layers of the onion and we come to realize you can actually average closer to 5%. Well, 4 or 5, that sounds like a rounding error, but that can be a big difference in lifestyle over, somebody's 35 years that they get to enjoy that extra difference.
Yeah.
So, it's a starting point, but as you said, Aaron, going through the actual analysis is where real value can be unlocked.
I'd say in practice, if my clients are willing to be flexible with spending, so that's one of the research supported caveats, that if the market's down, we reduce your spending a little bit. Like, don't go on vacation when the market's down. Don't buy a new car when the market's down. Like, we can kind of common sense adjustments. And there's different rules. Like, if you reduce your spending 10% or 20% in a single year, but you might be able to bump it up to 5%, and you'll still be okay if you're willing to be flexible. Another one, like if I have clients who are flexible and we're starting Social Security at 70, at age 60, we can usually get closer to like a 6 or 7% withdrawal rate, knowing that, okay, we're probably going to have to reduce that down to 4-ish 1 or 2 years this decade. I don't know which year, but 1 or 2 years, we have to be flexible. And so this allows us to wait for Social Security to start at 70, which is another one, like those little things, like it helps with the longevity risk at the back end. There's a variety of reasons why I like delaying for Social Security, but in practice, if we've had enough conversations and they understand the risks, starting at 6 or 7% at age 60 happens a decent amount. Now, again, there's no research you can go online and say, hey, it's fine to take out 7%. No, that's not, like, I'm very clear. It's not okay for general population to say, hey, I can withdraw 7%. But it's one of those, like, okay, knowing we have these other things that apply to you individually, and if you understand the planning risks, we could withdraw. And that might be, again, at $2 million, 4% is $80K, 5% is $100K, 6% is $120, and 7% is $140. So that $160K example at $2 million, they could be closer than they think. But as long as they understand, okay, we're no longer being conservative, we're now being middle of the road moderate with some of our risks.
Yeah. I think when you go through the analysis, that's where these opportunity considerations come up, and the helpful or the important considerations, as you had mentioned, are quite impactful. Being able to dig into 6-7% rather than being very conservative at 4 can mean a very different lifestyle in your 60s versus just following the letter of the napkin, I guess. And
the letter of the napkin, I like that.
Right. And just kind of being way too conservative than you essentially need to be. So it's important to have that distinction. You mentioned Social Security as one cash flow to think about. Of course, there could be other cash flows that are important for the equation. If you have a pension to lean up on. The other thing I like to mention to clients is, again, there's no magic rule where you have to stop immediately when you're age 60. For example, I always encourage clients to maybe think about, what if you just went part-time? And what if you didn't wait till age 60? What if you did that even sooner? How would that impact the analysis? So, having pedal to the metal, full-time employment for 2 people within a household at age 55, and then both immediately stopping, pretend that they both turned 60 at the same date. You don't need to do that, right? There's no set rule that's how it has to play out. And one thing that can really help on the cash flow side is, what if you start paring back at age 60 to part-time, A, to keep busy, and B, to make that lifestyle transition a little more easier. And then frankly, what we often discover is, hey, you could probably go to part-time a lot sooner than age 60. You might be able to do that in a year or 2, meaning you could start letting off the gas pretty soon and you still might be okay, especially if you plan on maintaining some sort of residual income on a non-full-time basis once you pass age 60. again, it may not be that much effort. It could be a quarter of the amount of effort in providing you, like 20% of your current salary, but that can make a big difference. If you're pulling a household income of, 200K a year, and then that drops down to 40K, well, 40K, as we mentioned on the 4% rule, could replace $1 million in your nest egg if you
Yeah.
keep that up. So it can go a long way.
I think we're dangerously getting close to my path of what do I talk to my clients about at 55. This, as mentioned at the top of the episode, Trishel went into like cash flow and accumulation versus decumulation. I think we still want to get to that today. I went into what are your hobbies? Where do you live? Who are your friends? Like, I went completely non-financial, and this is, we'll see if we get to it today. I guess we went in the whole episode. Like the example, a part-time job is a great example of something that both helps the finances. Like, it does make a lot of the projections look just that much better. Like Joe said, 40K of income has a value of like $1 million over a lifetime. But it's like over a long enough time frame. But also, it helps keep you busy, which is a very, very important part to like start planning out for retirement. So we're gonna use that as a jumping off point a little later. I wanted to get more thoughts from you about that, like accumulation versus decumulation, where we're not taking money out of the portfolio yet, but we are starting to mentally prepare for it.
Yeah, so as I mentioned, it's a bit of a different mindset. It's the notion that you can see the finish line, and now it's not about taking risks that you don't need to take. Even if you're completely willing to take risk, you just don't need to. You have this sense of fulfillment that could happen with financial independence, but what it really means is your employment becomes optional. There's a period or a transition period, as we're saying, where you won't need to rely on that. And here's what it also means: you certainly can if you want to. Like, if
Yeah.
age 60 comes and you still really want to, no big deal, MBD, right? You can
Yeah.
absolutely still keep going, but hopefully there's a mindset difference where you truly internalize this notion that you could stop any day you want, right? If you
I
wake
think
up one morning,
I think we've had that conversation about like the mindset shift that being financially independent gives you, where you have the FU money, like you could quit any day you wanted to, so you get to put boundaries at work that you may not have been comfortable doing in the past.
yeah. So going through this projections 5 years out, you may have that roadmap in front of you, and you may come to realize, I don't even need to keep the full pedal on the
Yeah.
career. Meaning, if I don't make exceptional on every annual
Yeah.
review for the next couple of years, I think I'll be okay.
Again, it comes at like when I start thinking non-financial, the clients who have that clarity that they're on track, they start. I know there's a whole like coast fire movement kind of thing, but they, like you said, they're not trying to get exceptional. They
Yeah.
have better boundaries. They stop working and stop checking email after a certain time of day.
Right.
They find that uh, their mentality towards work becomes healthier, and
Hmm.
because it's healthier, it's actually more sustainable.
Yeah.
Like, again, it's
Yeah.
like if you have those good boundaries and you don't feel burned out, you maybe they could work longer. It doesn't have to go back
Yeah.
to doing it part time.
I
Just
mean, yeah.
don't put in more than 40 hours. Like, you put like a solid 36 hours, you could do that a little longer, because like it'll start to feel lighter. Again, if you have that, like, you're on track.
And don't be surprised if your career just continues going along just
Yes,
as how it's been, if not better.
exactly. Yeah.
So that's entirely possible. And again, the difference is you have the confidence to know
Mm-hmm.
where you are on this trajectory, and just knowing that you're on solid ground, or by making these few key changes that you will be, it can make all the difference.
So I do want to get into a little bit of decumulation strategies, how we use your investments support your lifestyle. Because I have seen for a few clients where it's not accumulate, decumulate. There's actually a period where we're starting to get close. So now, like maybe like 1 or 2 years from potential retirement, where there's not the money you put into your 401k doesn't really have time to grow over 1 year. And so that 1 year's worth of savings versus going into cash or something else kind of doesn't matter. Like, yeah, we don't want to spend it too much, but you start getting into, like, I had a conversation with a client recently, like, they're now grandparents and they want to get a bigger car that their grandchild could fit in the back seat in the car seat a little easier. And like, okay, how do we pay for this car? Like, okay, well, the options, like, we could stop saving in your 401k. We could take a withdrawal from your IRA because that from an old 401k rollover. And so, like, any way we do the math, it's like you're putting money in one pocket, pulling out of the other, kind of thing. Well, eventually, like we talked about, okay, we're going to use a car loan where her income, her salary can pay the car loan until she stops working. And then 2027, we'll likely do a large IRA or 401k withdrawal to pay off the car loan balance. But you start to get, like, it's almost like a rounded kind of accumulation to decumulation. And they're not even yet at this point where, like, we're actually sending money every month to support lifestyle. And I have a few things I talk about with clients, but I want to get your perspective first of how do you decumulate? And so it's more from if they understand that a few years in advance, there are ways to take advantage of it. But, like, how do you decumulate from a portfolio into income?
Right. So one thing I want to mention is when people think they're going to be pulling out money or getting income from a portfolio, you often hear this, I need to invest in like high dividend companies or something, or I need like coupons and stuff like that, like for my bonds. And I want to make an important point that that's not what we're talking about here when we're transitioning the portfolio.
Okay, that's it. Okay. I have a side story. I'm worried it's too long. That is the legitimate financial planning thinking 40 years ago.
Yeah, probably maybe.
Where if you go back to like the 60s,
yeah, right.
Using bonds and the coupons from the bond, you actually had physical bonds, so you like took the coupon, wrote it down, it worked like a check you deposit in your bank account.
Fixed income, yeah.
But in the 70s, inflation in the 70s really hurt that strategy. And it's like, okay, we need equities to get some growth and outpace inflation to be able to support a retirement lifestyle.
Yeah.
But again, so like through the 70s, we started getting, okay, let's use those high dividend stocks. And then we get to the 80s, and a lot of it was just like pure price appreciation. It's like, okay, I got like 2 or 3% on my bond coupon. I got another 2% on my my high dividend stock, but the other stocks, they went up 100% over the decade. And like, how do I get that money out from like all that appreciation?
Yeah.
And so about in the 90s to 2000s, a lot of the research is now withdrawal based. So really it's kind of total return and withdrawals, where from the client perspective, they kind of don't care where that 4 or 5% comes from. And so we've now better, like, it's going to be a little bit interest on bonds, a little bit dividends, but it's also okay to sell shares of stocks, or in this case, diversified ETFs, to also supplement those withdrawals. So your withdrawals might be, you got a little bond interest, you got a little dividends, and depending on the timing, like you might have bond interest that gets reinvested in the portfolio for a quarter, and then now a systematic sale across the current investments, so you don't have money sitting in cash all the time. That's separate from the cash reserves. Like, Now it's like, yeah, we sell your bond fund, sell your stock fund to make up that withdrawal strategy. So that's what I say. We're no longer bond coupons and high dividend stocks. So I completely support that. That did have a place 40 or 50 years ago.
Yeah. So the focus now is on that total return, meaning what's the return across interest, dividends, and capital appreciation. And frankly, the real focus is on your after-tax total return. I mean, that's what you want to really concentrate on. So you actually don't want to target a strategy that pays more dividends than you need, because then you're going to have this extra income stream that you're not using, right? And then you're going to have this extra tax burden you don't need. So same thing with interest. If the goal is to maximize your after-tax total return, you want to be agnostic to the values of actual dividend, interest payments, and capital appreciation, because you're looking across everything and you're trying to make sure that you can grow the portfolio as sensibly as possible. So what that really means is, as Aaron, you had mentioned earlier in the conversation, you still have a diversified portfolio, but instead of being 100% stock, it may be something like 60-40, 60% stock, 40% bond. And what that means in practice is it's still a very well diversified portfolio. And it's full of dividend stocks and coupon paying bonds and so on. But your goal still is to take out a percentage, that we decide upon, and send that out, regardless of what's actually producing that income in a given period.
So an example might be, again, there's a few different ways. I think I summarized it down to 3 for a few clients, but your portfolio, you have your $1 million, it's 60-40. So you have, or sorry, let's say $2 million. So you have 1.2 million in a diversified stock ETF. We'll say there's not really a good single stock ETF that does it. A lot of times I'm still using Vanguard Total US Stock Index Fund and Vanguard Total International Stock Index Fund. But we'll say it's all one thing. And you have one single bond fund. We're going to say this is your 401k, so that we don't have to worry about the tax implications of the bonds. In a taxable account, probably more likely to use muni bonds depending on your income, especially in California, a high income tax state. So a lot of California muni bonds, much more likely. But we're trying, for this conversation, we're trying to ignore the tax status of the account. We're more focused on the asset.
Maybe you should bring that up.
Okay.
But that'll come later.
Okay, that'll come later. Okay. So like 1 month goes by and the bond stayed flat, but your stocks went up. Okay. You theoretically could take the entire withdrawal from the stock fund, depending on how much it went. If it went up 4%. It went 4% a month. It was like an amazing month, record-setting single month of like 4% in 1 month. Like, we don't even 4%. It'd be like 0.5%. We only need 0.5% because 0.5% over per month over 12 months is like a 6% return, and so that's enough to support your portfolio. It went up 1% 1 month. We can tell the sale that month could come from the stock side, and your bond stayed flat. Next month, stocks went down 2%. Sale that month could come from the bond side. And so the withdrawal from your IRA is still, what are we doing? We'll say 120,000 a month, 20,000 a year. So we're trying to do a 10,000 a month. It's still at 10,000 is like just 10,000 goes to your checking account, but the 2 months were different withdrawals. Okay. That is one strategy.
Yeah.
Next one, again, that's a very manual process, and you decide you don't want to hire advisors, you're doing it yourself, and you don't want to have to like go and make the sales every month. Next one is, okay, I'm going to just take my withdrawal, 6,000 per month from the stock side, 4,000 per month from the bond side. What happens there is, because the stocks are more likely to outperform the bonds, over time, over a year or two, what started as 60-40 portfolio likely is now 65-35 at some point. So you've actually added to your risk by systematizing it. And so you need to add in a kind of manual rebalance period.
Mm-hmm.
So the first one is kind of manual per month. Then you will take out, then we have systemized the monthly, and we have to manually balance. And the third one that, especially if they're kind of doing it themselves, I find a lot of people like is we'll take out $120,000 to fund like 1 year's worth of expenses.
Mm-hmm.
And this is on top of a cash reserve. So the cash reserve also could be a year's worth of expenses. So they might actually have 2 years of cash or 2 years of expenses in cash, but they're going,
Mm-hmm.
but then they're going to take out 10,000 a month from the cash to their checking account. They're going to go down from 240 down to 120. And then a year later, we'll take out cash. And that withdrawal also allows us to kind of rebalance at the same time,
Mm-hmm.
where it can be a little more tax efficient, where that monthly systematic, when we do that manual rebalance, that we're probably selling stocks at a gain to buy bonds, and we're probably adding taxes to that strategy.
Mm-hmm.
The single cash, single one-time per year withdrawal, we can use the withdrawal to rebalance. Like, okay, stocks were up, we're going to take more of that one-time withdrawal to rebalance. And so it kind of becomes a manual process once per year. We do get a little cash drag, so the total return on the portfolio is not quite as strong as with that first strategy, but it doesn't require you to check your portfolio every month to make the trades.
Mm-hmm.
So those are kind of a super high level of 3 withdrawal strategies of how do we generate the cash from our portfolio to get the money in our checking account.
Mm-hmm.
Do you have thoughts on those 3, or do you have something different, or do you have a preference?
No, well, so with our clients, we have software essentially which does the math for us. So what we get to do is, at a high level, we've done the plan. We figured out, okay, you need to pull out 120 grand over this year to support your lifestyle.
Mm-hmm.
And then we realize what that means is, 10,000 a month, but we know you're going to get X amount from like rental income and Y amount from your pension. So then we only need to pull out half of that from your nest egg. Let's say that's 60 grand over the course of the year, 5K a month. And then we say, okay, now we know we need 5K a month. So typically what I do is we have the target allocation, right? That let's say it is 60-40. Then we'll figure out, based upon where the current positions are, what do we need to liquidate to get as close to 60-40 and still get 5K out? And it's just some math, right? That figures that out.
Okay, so the first strategy, but using software to replace the manual work.
Yeah, because computers.
Yeah, no, I use a custodian called SEI, and they do that exact same thing. Like that's why I use that. And again, there's some level of cost somewhere in there, whether it's part of the advisory fee they're paying to you, Trishul, whether it's the cost to the custodian. Like, yes, there's some small level of cost, and in general, I do think that cost is worth it. I think to be able to do those, I'll call them dynamic withdrawals, where you don't know what you're selling next month to get your withdrawal, but we're going to get back to our 60-40 with each withdrawal. That does tend to both be most tax efficient and work out the best. Yeah.
So the goal is, computer, let me know what I need to sell to get most in line with the target. Let's go ahead and sell it. I do actually the investment management for my clients, which means I'm the one who's doing all that. But again, computers, math.
Yeah.
It figures out what to trade and blocks them and all that across my clients. Now, what that means is, essentially, on my end, there's a 2 times a month process for handling investments on the trading side, 2 trades a month. So in the second half of the month, we'll be basically putting new money in to work,
Mm.
right? That means also, even if you're pulling out, you might have some dividends and stuff like that need to be reinvested, right? Especially if those dividends are above and beyond what we know we're going to pull out for the next month. And then at the beginning of the month, I do liquidation trades, which is money to get ready for that money to go out. So basically what the clients see is essentially they'll be sending me money in the middle of the month and they'll be getting a paycheck in the middle of the month. And it might be both or one or the other, depending on where they are in their trajectory. But what it means from a specific client's perspective is, it would be like you get a $5,000 a month paycheck for the rest of your life. And here's how that $5,000 plays in. What I like to say to clients is, you don't need to track every expense, but let's say it is $10,000 that we've targeted that you need on a monthly basis, $120K a year, and we know that you'll be going to be getting in a given month $5,000 from these other sources. I'll send you the other $5,000 each month, meaning let's have a separate account where this $10,000 goes into. Let's put your emergency fund in there so you have a $30K buffer. And then each month it's going to get topped up with another 10. And then all we have to see is over the next 6 or 7 months, does that $30,000 watermark for your emergency fund go up or down? Right. And if we come back 6 months from now and all of a sudden you have 40, 45 grand in there, we know, hey, you could probably spend a bit more, or we don't need to take out as much. And during our semi-annual checkups, we'll just adjust that accordingly.
I love the idea of like doing little experiments like that. Like, okay, if we send you this much each month, a couple clients I've added separating regular monthly expenses, like including food and entertainment, from likely annual expenses, things like property taxes, insurance, vacations. And so we might put like of the 10,000 per month, 6,000 goes in their checking account that gets used every month. 4,000 goes to their annual savings account, but they know like, okay, I can use that anytime to pay for vacation or my property tax bill. I know where that money's coming from. But I love experiments with mental accounting, because for each client it's gonna be a little different. And kind of playing around with, okay, how do we just get a good idea of what you're spending without actually having to track things.
The good thing about this way is you're not tracking a single thing at an individual level. You're really just tracking one number. What's the balance on that one account? And is it growing or decreasing over time? And that'll give you a rough idea of how things are. And the good news is, because we do put in all the expenses that we do project for the year, if it is like November and you do end up with like a $15,000, $20,000 surplus, we've accounted for that. You can spend it. Go out, have a bigger vacation, have a party, whatever you want. But realize that when we put it into the plan and we said you could spend it, we really meant that. Like, that's available to spend. And if you don't want to, that's fine. But that just means you're going to have more money later to spend.
I think this is the other good point of, as we get, I think this will be like our jumping off point for our next conversation. I also find myself recommending clients, you can spend your own money. You have this, we've accounted for it in the strategy, the portfolio can support it, you can spend more. But because they have been saving so well for so long, they don't always feel comfortable spending that. And this is another one of the non-financial things to think about as you prepare for retirement. Again, most of my clients, I find the same thing. They end up with more cash in their checking account because they're like, oh, I want to have just a little extra cash in case my portfolio like goes down. It's like, well, we have our cash reserve. Like, we have a strategy. We have the bond side. It's like, we've already built in enough protections on the investment side that you don't need the extra cash. You only need the first extra cash.
Right. You know, that since we're 5 years out from retirement, it does bring to light a few other auxiliary concerns around that. For example, 5 years out from retirement, if we have a plan, then it might give you some understanding that when you do retire, you could probably spend more than you're spending now,
Yeah.
right? And we've talked about this in other conversations, but the notion there is you don't need to have a fixed X% over your entire financial independence zone, right? Or your entire retirement period. In fact, for many people, it may make sense to spend more in the early periods of retirement, right? And what happens?
Along with that, I've had conversations with clients like, okay, we don't need to add to your 401k, but if we can let it grow 60-40, just get a little bit of growth for 5 years, then you'll have plenty. And if we continue saving your 401k on top of that, we're gonna have even extra plenty.
Yeah.
We could stop adding to your 401k, which will increase your take-home pay, and just let the money grow. This has happened a handful of times of like trying to prepare clients for that idea that if they work 5 more years, they most likely can spend more than they're spending now. Yeah. But they don't see the money in their checking account, so they don't feel comfortable doing that.
Yeah. So it's worth doing the analysis and seeing the impact, right? So in the analysis, this would look at like, I guess the industry, we call it like the spending smile, right?
Yeah.
The notion is in early retirement, there is room to spend more. If we realize in the middle period of your retirement, you will probably be spending less. Like in your 80s, you may not take as many vacations as you took in your 60s, right? And then it's called a smile because we do want to acknowledge the notion that towards the end of life, expenses do increase primarily because of healthcare expenses.
Usually it's usually healthcare, long-term care.
But it's better. You can come out ahead than just having a fixed inflation adjusted spend rate over your entire retirement period by being a little bit more opportunistic.
Yeah.
I would say there's a few more slightly technical things you could do to be a little bit even more opportunistic. As we mentioned, you're 55 now. One thing to think about is you're not going to have RMDs until you're in your middle to mid 70s. So just a little bit of an edge that you can consider is employing a Roth conversion strategy during the period where you're not earning so much income, but you have these pre-tax funds that you can roll into your Roth IRA opportunistically.
I tell clients in their 60s, we don't want a 0% tax rate in a year. We really want to target like 10%, because if we can get 10% through your 60s instead of being 25 in your 70s, we might get down to 20% in your 70s once we add in the RMDs.
Yeah, we want to take advantage of those low tax years to make sure that you're being opportunistic about that. So that's one thing to consider.
There's also gain harvesting. So I think it's roughly 60K of capital gains for married filing jointly would be a 0% tax rate.
Yeah.
So there's no wash sale on gains. So you could actually sell something for a gain, add it to your taxable income, buy the exact same thing. So you stay fully invested, but you've now kind of raised your basis for future sales to have less taxes in the future.
Right. I'm just going to reference that number. I think we've got some inflation adjustment on that 0%. So
I was trying to, it's
cap
like
gains.
The married filing jointly cap gain number minus the standard deduction for husband and wife.
Yeah, it's around 98K now.
Okay.
At 0%. Yeah.
Okay.
On your taxable income. So it's just one of those use it or lose it types of things. And that's a period, when your income is lower, that you should use it. Otherwise you'll lose it. The other, like probably third order thing to consider is that we alluded to this also a bit earlier. When you're withdrawing money, when you're in the decumulation phase, you are inevitably going to have assets in different tax advantage types of accounts, whether you have it in a Roth, or a pre-tax account, or it's in an HSA, or it's in a 529 even.
Yeah.
Or it's just in a standard taxable account. So if you want to pull out that 5%, the naive way is you just prorata it and you just pull it out, just depending on the account size. But you can be a little bit more opportunistic. You can understand your tax burden in a given year and aim to pull out in a given account to maximize that over the current year and also to help keep your taxes low over the next 30, 40 years.
Yeah.
So there's different withdrawal strategies that you can take advantage of to keep your tax burden lower, which means more after-tax income, more total return after taxes.
Which you can also, again, we have both the Roth and the pre-tax. You put more of the stocks of your 60/40 in the Roth side and more of the bonds in your pre-tax side, so that your RMDs in your 70s are actually lower because you did not get as much growth in the pre-tax side, and all the growth and accumulation is on the tax-free side.
Yeah, so that's another.
It's called asset
second or third order.
Yeah, that's like a fourth order strategy. Yeah.
Which, yeah, certainly, if we're doing the work, that's what we do.
Yeah. Okay, so I think this is a good financial preparation 5 years before retirement. Again, I think we'll have a whole other conversation about the non-financial stuff. It's going to be, like you said, that savings versus spending mindset, the part-time work. It's going to be like, for me, it's the friends, hobbies, where you live, paying off mortgage. Like, there's a lot of other psychological benefits to make sure that you feel you're thriving in retirement, not just you're financially independent. Like we want to make sure you actually enjoy lifestyle, because as a financial planner, one of my bigger concerns for clients in retirement is not financial. I feel confident I've done the work with them. They're in a good place. They're not going to run out of money. I do worry about depression. I do worry about that they have lost a sense of meaning, and this is more likely to have an impact on their lifestyle than the stock market. Mm-hmm. So doing a lot of the groundwork 5 years in advance to make sure that they are thriving is what we'll talk about next time.
Good stuff, Aaron.
Okay. Great conversation, Trishul. Thank you.
Well, enjoyed the conversation as well. If you like these, do subscribe, like, and share. Thanks, everybody. Bye. Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.